Welcome to today's Explainer. If you've ever felt like your corporate initiatives are just operating in total chaos, you are absolutely not alone. Today, we're going to take those wildly unpredictable market charts and translate them into a highly structured risk management framework. And this is built specifically for you, the business leader. So if you're tired of just leaving capital allocation up to chance, well, this visual approach is going to completely change how you measure and manage risk. Let's get right into it.
Here's a quick look at our agenda. We're going to cover visualizing market volatility, deconstructing risk, the process breakdown, structuring multiple exit targets, cross-asset risk strategies, and finally, your takeaways as a business leader.
All right, Section 1, Visualizing Market Volatility. Let's take a look at the raw reality of unpredictable market movements. Okay, so what we're looking at here is a Solana price chart. And yeah, it's full of these super sharp drops and aggressive climbs. Honestly, it looks completely chaotic, right? But it perfectly mirrors the volatile environments that you navigate every single day. Think about it. Sudden shifts in consumer demand, massive supply chain shocks, aggressive moves by your competitors. The business landscape is literally never flat. It moves exactly like this.
So, to make sense of all this jumping around, we've got to understand the visual language. Now, to a non-technical executive, these green and red bars, which are called candlesticks, might just seem like confusing jargon, but they're really just simple visual models. Every single candle shows the literal battle between upward and downward momentum over a set time frame. Green, that means the buyers are in control. Red, the sellers are dominating. By reading these, you're essentially mapping out volatility as it happens.
Moving on to Section 2, Deconstructing Risk. This is where we actually bring mathematical order to all that visual chaos.
Notice the colored boxes overlaid right onto the chart. What we're doing here is imposing our own strategic order onto the chaos. That red box, that defines a strict stop amount of 3.6. Think of this as your absolute walkaway point. It's like pulling the plug on a failing product launch before it completely drains you. On the flip side, the green box projects a target of 14.4. And this is not guesswork. You are defining exact, mathematical parameters for what is an acceptable loss versus your projected upside.
And that brings us to a massively important number, 4. This exact setup gives us a clearly defined risk-to-reward ratio of 4. Now, what does that mean in plain English? It means your potential reward is mathematically 4 times the capital you're putting at risk. For a business leader, this right here is the holy grail. I mean, you never want to greenlight a project where you risk $1 million just to make $1 million, right? You want to engineer situations with asymmetrical upside, where your clearly defined risk is completely dwarfed by your structured target. Okay, Section 3, the process breakdown. Let's turn this math into a repeatable framework for your capital allocation. The true beauty of this framework is just how incredibly simple it is. Seriously, whether you're trading a digital asset or launching a massive new corporate initiative, the steps are exactly the same. Step 1, establish your entry point. Step 2, strictly define the maximum downside. That's your absolute stop loss, the point where you kill the project, no questions asked. And Step 3, project your upside targets. Now, here is the absolute crucial part, and honestly, it's where most corporate projects actually fail. You have to define all 3 of these parameters before you commit a single dollar of funds. Section 4, structuring multiple exit targets. Because hey, the strategy absolutely doesn't end just because you're in the green.
So, once a venture actually becomes profitable, how do you manage the exit without leaving money on the table? Well, this Bitcoin chart brilliantly illustrates the solution. Instead of relying on just one massive green target box, we've got a multi-tiered exit strategy. Notice how we have Target 1, Target 2, and Target 3 distinctly mapped out. We are not sitting around waiting for the absolute perfect magical moment to cash out entirely. We're structuring our success in phases.
Think about the immense business benefits of these phased exits. By scaling out of a successful venture in stages, you hit Target 1 and immediately secure early profits. Bam! You've quickly recouped your initial capital risk, but, and this is key, you don't close the whole project down. You safely let the remainder run to capture the maximum asymmetrical upside at Target 3. And maybe best of all, predefining these targets completely eliminates emotional decision-making when you're in the heat of a booming or busting market.
Section 5, cross-asset risk strategies. Now, you might be wondering if this structured approach only works for wildly speculative assets.
Let's compare the Bitcoin setup on the left with the gold CFDs on the right. Completely different assets, driven by completely different market forces. And yet, look at them. They use the exact same green and red risk boxes, the exact same multi-target strategies. This just proves that this isn't some niche crypto trading trick. It is a universal law of risk management. It applies just as effectively to a brand new SaaS startup as it does to traditional manufacturing.
And finally, Section 6, Takeaways for Business Leaders. Let's synthesize all this visual data into actionable intelligence for your boardroom.
So here is your executive summary. The red stop loss essentially means mathematically capping your project losses. You must know your absolute walkaway number on day one. The green target means you're actively hunting for asymmetrical upside, stuff like those 4-to-1 ventures we talked about earlier. And those phase targets? That's about strategically scaling out of investments to secure early ROI. Again, these are not just trading concepts, they are absolutely mandatory practices for any strategic decision maker.
As you evaluate your own work this week, I really want to leave you with this question. When you look at your current corporate initiatives, how clearly have you visualized your mathematical stop loss? Are you just leaving your business risks to chance? Are you mathematically defining your exact exit before you even enter? Try applying this framework to your very next big decision and just watch how it transforms your strategic clarity. Thanks for joining me on this explainer, and I'll catch you next time.